You're listening to the Retire Coast podcast, where money, business, and lifestyle come together. Join us each week as we explore smarter financial planning, starting and growing businesses, and building the life you want at every stage, from Millennials and Gen X to today's retirees.
Thank you for coming to Retire Coast podcast. The topic today is going to be 11 best 2026 tax changes Millennials and Gen Z should understand now. Now, when I created this article, it was actually a reaction from another article that I wrote, the 11 myths that millennials hear and actually often pass around. Some of it comes from TikTok and other places like that, but without foundation. And some of them have to do with taxes and, the rich get all the tax breaks and that kind of thing. So last year, when the big, beautiful bill was passed, there was a lot of criticism that it was mainly for the wealthiest people. Well, I decided to dig into it, and that's why I wrote this article and I am doing this podcast, because I found out that actually that was not true. It was almost the reverse. Many of the changes that are included, we're going to talk about here in this dialogue to follow, are only effective for people that are hourly wage earners. There aren't many millionaires that are hourly wage earners. There might be one or two, tongue-in-cheek, of course. However, it's some of these are only for those individuals. They're not for people that are on a salary. Now, there are other things for people on a salary also. So there's a lot of things in here for pretty much everybody, but people that are wealthy, because there are limits on almost all of these benefits that came from the big, beautiful bill last year. And the limits are dollar limits. So if you earn too much money, for example, $150,000, $200,000, depending on what the issue is, you get cut off at that point. So this bill was never intended for people that were wealthy to begin with. And I thought that was kind of ironic. So I decided to do this podcast. I think you'll enjoy it. And it's also very important that you listen to the things in there where we talk about what you need to do to make sure that you get the maximum benefit, because while this is being handed to you by Congress, there are still some steps you need to take to make sure that you get the benefit from it. So listen to our podcast, and please come back to retirecoast.com and listen to other podcasts as well.
Good morning, good afternoon, or good evening, wherever you are in the world.
Hello there.
It is Friday, February 6th, 2026. And if you are anything like me, or really like most people in the working world, you probably have a stack of envelopes kind of accumulating on your kitchen counter right now.
The dreaded stack.
Yeah, dreaded stack. W-2s, 1099s, mortgage interest statements. It's the annual autopsy of your finances.
That's a good way to put it.
And usually when we look at that stack, the feeling is just dread. It's panic. It's a rush to find a software login and just get it over with.
Get it done, yeah.
But today, we are going to ask you to put down the panic button.
Please.
Put down the coffee. And actually, don't open those envelopes just yet.
Because if you're just opening them to file a return, you're already behind. You're looking at the past.
Exactly. We are staring down the barrel of tax season, but the message we are diving into today is that the game has fundamentally changed.
It really has.
We aren't just talking about, inflation adjustments or a slightly higher bracket here and there. The actual architecture of how you pay taxes, and more importantly, how you save on taxes, has shifted under our feet for 2026.
It really has. And it's shifted in a way that is, it's specifically designed for a demographic that usually gets the short end of the stick.
We are talking about Millennials and Gen Z.
Right. If you are hitting your peak earning years, maybe you just bought a house, maybe you're raising a family, or maybe you're juggling a side hustle with a 9-to-5.
A lot of people.
Yeah. This is the year where the rules were rewritten for you. But, and this is the critical part, they were rewritten in a way that requires you to pay attention.
So to help us navigate this, we are digging into a really comprehensive, almost encyclopedic guide from Retire Coast.
It's a great one.
It's titled 11 Best 2026 Tax Changes Millennials and Gen Z Should Understand Now by Bill Anderson. And let me tell you, when I first read the title, I thought, okay, another listicle.
Right. Clickbait.
But about halfway through, I realized this isn't a listicle. It's a blueprint.
It's an operating manual for the modern economy. And the reason we are doing this deep dive now in early February is because of the date. It's 2026.
Right.
Most people are gathering their documents to file for last year. for 2025.
Yeah.
But the changes we are discussing, they apply to the money you are earning right this second, today.
That's the hook. That is the whole point. The source material makes this massive distinction between filing taxes and tax planning.
And we should dwell on that for a second because it's the most common mistake people make.
I think so too.
Filing taxes is a history report.
Yeah.
It is reporting what happened. You cannot change history. If you overpaid, you get a refund. If you underpaid, you write a check. It's done.
It's rearview mirror stuff.
It's all rearview mirror. Tax planning is looking forward. It's deciding how to structure your life before the year closes so that the history report looks the way you want it to.
And the scary part, and the reason we need to have this conversation, is that most of these new massive benefits do not automatically show up in your paycheck withholding.
No, they don't. I mean, think about it. HR departments are notoriously slow to adapt to complex legislative changes like this.
Right.
So if you are just cruising on autopilot, letting your employer withhold the standard amount based on your base salary, you are essentially giving the government an interest-free loan of thousands of dollars.
Or worse, you're missing out on strategies you need to implement now, like literally this week, to qualify for the savings later.
Exactly.
So our mission today is pretty clear. We aren't just going to read the list from the article. We are going to unpack the structure of this new tax landscape.
And we are going to build toward a concept the author calls stacking.
Stacking. I love this part. This was my favorite section. It's the secret sauce of the whole deep dive.
It is. It's the idea that, while one deduction might save you $50, combining 4 or 5 specific changes in a specific order can save you thousands.
It's the synergy.
It's all about synergy.
Okay, let's unpack this. We have to start at the bottom, the foundation. Before we get to the sexy stuff like deducting car loans,
which is coming.
Which, yes, we are absolutely going to talk about because it sounds insane. We have to talk about the one big beautiful bill context.
Right. To understand 2026, you have to go back in time to 2017.
The TCJA.
The Tax Cuts and Jobs Act, or TCJA. When that bill was passed, it made a lot of changes, but a huge chunk of them were temporary. They were written with an expiration date, December 31st, 2025.
The famous sunset. I remember hearing about that for years.
Exactly. We were facing a massive tax cliff. If Congress hadn't acted, on January 1st of this year, rates would have snapped back to 2017 levels. The standard deduction would have been cut in half.
So a massive tax hike.
A massive tax hike for almost everyone.
But that didn't happen.
It didn't. The legislation passed recently made these lower individual income tax rates permanent. And that is change number 1 in our source material.
Okay, so we avoided the cliff, but I can hear a listener right now saying, okay, great, my taxes didn't go up. That's not exactly a benefit. That's just avoiding a penalty.
Right.
Why should we care about this? Why is this a big deal?
It's about certainty. And, there is a nuance regarding tax brackets that millennials specifically often misunderstand. We need to talk about the cliff mentality versus the bucket reality.
The classic misunderstanding of marginal versus effective rates.
Precisely. Let's do the explain like I'm 5 version of this because it is so, so vital.
Please.
People hear 37% tax bracket and they panic. They think, if I earn $1 more and cross into that bracket, suddenly the government takes 37% of all my money.
I have had friends turn down raises because of this. They say, I don't want to bump into the next bracket. I'll actually take home less money.
Which is mathematically impossible in a progressive tax system.
Right.
Think of your income like filling up buckets.
Okay, buckets.
The first bucket, let's say the first $11,000 you earn is taxed at 10%.
A low rate. Super low. Once that bucket is full, the water flows into the next bucket. The next chunk of money is taxed at 12%, then 22%, then 24%.
So if I'm in the 24% bracket, only the money in that top bucket is taxed at 24%.
Exactly. The money in the first bucket is still taxed at 10%. The legislation keeping these rates permanent means we get to keep using these wider, cheaper buckets.
I see.
If we had gone back to pre-2017 rules, the buckets would have shrunk and the rates on them would have gone up. So even though it feels like nothing changed, what actually happened is you locked in a historically low effective tax rate.
And that stability, that certainty, is the real benefit.
That's the benefit.
And that leads us directly into change number 2, which I think affects way more people in a practical sense, the standard deduction.
The new foundation.
It's permanent,
Yeah.
and it is huge.
Yeah.
The TCJA nearly doubled the standard deduction back in the day, and now that is locked in. Plus, for 2026 through 2028, there are these temporary boosts that make it even higher.
Right. And we need to shift our mindset on what the standard deduction even represents. I'll be honest, I used to think of the standard deduction as the lazy person's tax return.
A lot of people did.
Like, oh, you didn't keep your receipts, you didn't have enough cool deductions. Here, take this participation trophy.
That's how it used to be. If you were sophisticated, you itemized. But now, that's the wrong way to look at it.
So what's the new way?
The standard deduction is now the foundation. It's the floor. It means that the first, let's call it $14,000 or $15,000 for a single person, nearly $30,000 for a couple, is just tax-free. Zero. Gone.
Simplicity.
Massive simplicity. Most millennials, especially renters, will never need to itemize again. But here's the magic of the 2026 changes.
Okay.
In the old days, if you took the standard deduction, you couldn't take any other deductions. It was an either or choice.
Right. You were locked out of the other perks.
Correct. But the new legislation has moved a whole host of benefits to be above the line.
Okay, above the line. We are going to use this term a lot today. Let's define it.
An above-the-line deduction lowers your adjusted gross income, or AGI, before you even look at the standard deduction.
So, before the choice.
Way before. This is crucial. It means you get to have your cake and eat it too. You get the massive standard deduction, plus these new specific deductions we are about to discuss.
You get to stack them.
You get to stack them. And that is where the game is played.
Okay, let's get into the specific perks, because this is where it gets really interesting for the working crowd. The source material breaks this down into what we are calling the work hard bundle.
Section 2 of our deep dive. Let's do it.
Let's talk about overtime. I worked a lot of hourly jobs in my 20s. And the narrative on every job site, in every break room, was always, don't work too much overtime, the taxes will kill you.
You're working for free.
You're working for free, exactly.
It is one of the most persistent myths in personal finance, but historically, it felt true because of withholding.
It did.
You get a big check, the taxes look huge, and you feel robbed. But now, under change number 4, there is a specific deduction for qualified overtime pay. This is active from 2025 through 2028.
Okay, so explain this to me. Does this mean if I work 50 hours, that extra 10 hours is tax-free?
No. And this is where we have to be extremely precise. The source material is adamant about this distinction. If you get this wrong, you will get audited.
Okay, noted.
It is not a deduction for your overtime wages. It is a deduction for the overtime premium.
The premium. Okay, let's do some math. Break it down.
Let's say you work at a manufacturing plant.
Yeah.
Your base pay is $20 an hour.
Got it.
When you work overtime, you get time and a half, right?
Right, $30 an hour.
Exactly, $30 an hour. The IRS looks at that $30 and splits it into 2 parts. Part A is your straight time, the $20 you would have made anyway. That is still fully taxable.
Okay.
Part B is the premium, the extra $10, the half, in time and a half.
Okay, I'm with you.
This new deduction allows you to deduct that $10 premium from your income.
So the penalty feeling of working overtime, that extra effort tax, is what's being mitigated here.
That's it.
The government is basically saying, we know it sucks to work Saturday night, so we won't tax the incentive pay.
Exactly. It's designed to encourage labor force participation in key sectors. The source mentions healthcare, public safety, manufacturing, hospitality. It's where the hourly worker is grinding it out.
But there are gotchas, right? There are always gotchas with the IRS.
Plenty. First, you have to be an hourly employee. If you are salaried and you stay late to finish a PowerPoint deck, sorry, no deduction.
Bummer. Okay.
Second, it doesn't apply to bonuses. If your boss gives you a $1,000 holiday bonus, that is not overtime premium.
And limits. There must be limits.
Yes. There are annual caps. For a single filer, the deduction is capped around $12,500. For joint filers, $25,000. And there are income phase-outs.
Of course.
If you make too much money, usually high 6 figures, this benefit fades away.
But here is the problem I see. I'm picturing a pay stub. Usually it just says overtime earnings, $5,000. It doesn't break out the premium.
And that is the biggest aha moment of this section. That's the action item. You have to check your pay stub. You need to see a line item that specifically says OT premium or overtime at 0.5.
Really?
Yes. If your payroll department just lumps it all together as wages, you might have a fight on your hands trying to prove it to the IRS.
So the action item here isn't just file your taxes, it's check your ADP portal right now.
It is. Go look at the line items. If it's not broken out, go talk to HR. Ask them, hey, for the 2026 tax year, are you going to report the overtime premium separately? Because if they don't, you are leaving free money on the table.
And this is above the line.
And again, this is an above line deduction. You take the standard deduction and you take this.
That is massive. Okay, moving on to another group of hard workers, The gig economy, folks. Servers, bartenders, Uber drivers. Let's talk about change number 6. Federal tax relief on tips.
This one made a lot of headlines during the legislative sessions. You probably saw tweets saying, no tax on tips.
I did. It sounded way too good to be true.
Because it was too good to be true. It is not no tax on tips. It is a deduction for qualified tips.
What's the difference? What does qualified mean?
The difference is reporting. This is actually a brilliant move by the IRS to stop tax evasion.
Ah, I see the angle.
To get the deduction, the tips have to be reported in your payroll system.
I get it. So if you're a bartender and you pocket $200 in cash on a Friday night and never tell anyone...
That money doesn't exist to the IRS. You can't deduct what you don't declare.
Sure.
But if you report it, yes, your income goes up. But then you get to take this deduction to bring it back down.
So it incentivizes honesty.
It does. It applies to food service, delivery, rideshare. And just like the overtime rule, it helps with phase-outs. We'll get to this later. But keeping your official income low is the key to unlocking other credits. This tip deduction helps you do that.
It's all part of the stack.
It's all part of stack.
Okay, let's shift gears. We've talked about earning money, sweating for it. Now let's talk about spending it, specifically on the big stuff, cards and houses. This next one. Honestly, when I read the guide, I thought it was a typo.
The vehicle loan interest deduction.
Yeah. Since when can we deduct interest on a personal car loan? That hasn't been a thing in forever.
Not since the mid-1980s. It's been a long, long time. But change number 5 brings it back, specifically for 2025 through 2028.
Why? What's the context?
It's a direct response to the explosion in vehicle prices and interest rates we saw in the early 2020s. Cars just got incredibly expensive.
Okay, so just to be crystal clear, I can write off my car payment.
No. Stop right there. Not the payment, the interest.
Right. The interest. Sorry.
And only up to $10,000 of interest annually.
Still, $10,000 of interest, that covers a pretty massive car loan. I mean, even at 7% or 8%, you'd have to have a huge loan to hit that cap.
It covers almost any standard vehicle loan, yes.
Yeah.
But there are criteria, and they are strict. First, it has to be a personal use vehicle. No deducting the work truck if you're already writing it off as a business expense. You can't double dip.
Makes sense.
Second, and this is the economic nationalism piece, it has to be primarily U.S. assembled.
Oh, interesting.
Yeah, they're trying to support domestic manufacturing with this one. So if you bought an imported luxury sedan, you might be out of luck.
And the big one, leases. What about leases?
Leases do not qualify, period. Because in a lease, you aren't technically paying interest on a loan. You're paying for the depreciation of the asset while you rent it.
So no interest component.
No interest component.
Right.
So if you are leasing your car, you are out of luck on this specific deduction.
But if I bought a Ford or a Tesla or a Chevy last year and I'm paying 7% interest on it.
That interest is now deductible. And here's the drum roll. It is an above-the-line deduction.
Incredible. So again, I don't need to be a homeowner. I don't need to itemize. I can be a renter in an apartment taking the standard deduction and still write off my car loan interest.
Exactly.
Yeah.
It lowers your AGI directly. And think about the millennial demographic here. You might not own a home yet because housing is expensive, but you probably own a car to get to work.
True.
This puts money back in your pocket. It's a huge shift in equity.
Speaking of homeowners, though, we have to address the elephant in the room, the SALT cap.
The state and local tax deduction, yes.
Yeah, for the last few years, this has been the bane of existence for anyone living in New York, California, New Jersey.
Any high-tax state.
Right. Basically anywhere with good pizza or good beaches.
Or just high property taxes. The cap was stuck at $10,000. So if you paid $15,000 in state income tax and another $10,000 of property tax, you were paying $25,000 total.
You could only deduct $10,000.
And the rest just vanished.
But change number 7 flips the script.
It jumps the cap to $40,000. Temporarily.
That is a massive jump. I mean, that covers almost everyone except the ultra-wealthy.
It is. But, and there's always a but.
Uh-oh.
This is a below-the-line deduction.
So this is where the strategy gets tricky. Explain the difference again. Why does that matter?
To use the SALT deduction, you must itemize. You have to say no thank you to the standard deduction.
I see.
So you have to do the math. Does your $40,000 in state taxes plus your mortgage interest exceed the new higher standard deduction?
So for a lot of people, even with the higher cap, the standard deduction is still better.
For many, yes, especially if you don't have a massive mortgage. But if you are in a high-tax coastal market, or maybe you moved from Texas to California recently,
right,
you need to recalculate your entire strategy. Suddenly buying a home in a high-tax area looks a little more mathematically feasible than it did 2 years ago.
It really changes the geography of financial planning. It removes the penalty of living in those zip codes.
It does. But notice the architecture. Car loans above the line help everyone. SALT below the line only helps if you itemize. You can't just assume you get both.
Got it. Okay, I want to move to what I call the heart of the deep dive. We've talked about work, we've talked about cars and houses. Now let's talk about family and health.
Yes.
Because for the folks hitting their 30s and 40s, this is where the budget really bleeds.
The family block. This is where we see the difference between a deduction and a credit really shine.
Okay, let's do a quick educational pause. We throw these terms around, credit versus deduction. What is the elevator pitch difference?
Think of a deduction like a coupon.
Okay, a coupon.
It lowers the price of the item you're being taxed on. If you earn $100,000 and have a $1,000 deduction, the IRS now thinks you earn $99,000.
So you save the tax on that $1,000.
Right. So maybe you save $200 to $300 in your pocket. It's pennies on the dollar.
Got it. And a credit.
A credit is a gift card. It lowers your tax bill, period, dollar for dollar. If you calculate your taxes and you owe the IRS $5,000, but you have a $1,000 credit, now you owe $4,000. It is literally cash in your pocket.
So credits are significantly more powerful.
Much, much stronger.
Yeah.
And change number 3 involves a big one, the child tax credit, or CTC.
And the numbers are up.
They are. It's up to $2,200 per qualifying child. And the reliability is better. The refundable portions are enhanced, meaning even if you don't owe taxes, you might get a check back.
$2,200 per kid. That is real money. That's diapers, that's soccer cleats, that's, well, like 2 weeks of daycare in some cities.
Let's not get ahead of ourselves on daycare costs, but yes, it helped.
Fair enough.
However, the child tax credit has a kryptonite.
Which is?
Income phase-outs. If you make too much money, the government starts taking this credit away from you.
Yeah.
It fades out.
At what kind of income level?
For a married couple, once you cross a certain threshold, it's usually around $400,000, but it varies by year and filing status. It starts to disappear.
And this brings us back to our secret code, AGI.
Precisely. This is why above-the-line deductions are so valuable. If your income is right on the edge, so you made a little extra money this year, you might lose the credit. But if you can use those deductions, the overtime, the car loan interest, to lower your AGI, suddenly you might qualify for the full child tax credit again.
You're saving money by lowering your income on paper, which unlocks free money from the credit. It's a double win.
That is the game. That is the whole point.
Let's talk about that daycare bill, though. Change number 8, enhanced child and dependent care credit.
This is specifically for costs incurred to enable you to work.
What does that mean, enable you to work?
It means daycare, after-school programs, summer day camps, things you pay for so that you can go to your job.
Summer day camps count.
Day camps, yes. Overnight sleepaway camps, no. The IRS draws the line at roasting marshmallows overnight.
That's a funny line.
If they sleep there, it's a luxury. If they come home, it's care.
Good to know. And kindergarten tuition?
No. Once they enter school, so kindergarten and up, tuition is considered education, not care. But before that, or for after-school care, yes.
Now, here's a trap I've fallen into. The FSA.
The flexible spending account, yes. Many employers offer this. You could put pre-tax money aside for childcare.
And the trap is?
The trap is double dipping. You cannot use the same dollar to pay for daycare tax-free via your FSA and claim a credit on it.
It's a puzzle. You have to choose.
It is. Usually the FSA is the first line of defense because it saves you payroll taxes too. The credit cleans up the rest. But you have to run the numbers. You can't just throw receipts at your accountant and hope for the best.
Speaking of health and accounts, let's talk about the ultimate tax vehicle. Change number 9, the HSA, Health Savings Account. The limits are up again.
For 2026, we're looking at contribution limits of $4,400 for an individual and $8,750 for a family, plus a $9,000 catch-up if you're older. But for our demographic, let's focus on the main limits.
Why do financial nerds, and I say that with love, you are one of them, why do they obsess over the HSA? It's just for medical bills, right?
It is a triple tax threat, or triple tax advantaged. It is the only account in the U.S. tax code that does all 3 things.
What are the 3?
1, you put money in tax-free. So it's a deduction. It lowers your AGI. 2, it grows tax-free if you invest it in the market. No capital gains.
Okay.
3, you take it out tax-free if you use it for medical expenses.
It's untouchable.
It's mathematically perfect.
Hey.
But in the context of 2026, its role is even more specific. The HSA is the ultimate stacking tool.
Because it is above the line.
Correct. Every dollar you throw into your HSA is a dollar the IRS doesn't see as income. If you are right on the edge of a phase-out for the child tax credit, dumping $4,000 into your HSA might save you $2,000 in lost credit.
Yow!
That is an insane return on investment. You keep the money in the HSA and you get the credit.
That is. Okay, my brain is starting to buzz. This is the stacking concept coming to life.
This is it.
But before we build the full stacking scenario, we have one more section to cover. Education and debt.
Change number 10. Student loans and Pell Grants?
Student loans, the defining feature of the millennial balance sheet.
Sadly true. There was a lot of talk about forgiveness, court battles, policy shifts. It's been a roller coaster.
A huge roller coaster.
But the tax code focuses on something simpler. Interest.
The $2,500 deduction.
It is still active. It is still above the line.
Even if I make decent money. I thought that went away for a lot of people.
Well, there are phase-outs. If you make over $90,000 single or $185,000 married, it starts to go away. But again, it connects to everything else. If you use the HSA to lower your income, you might keep your student loan interest deduction.
It's all connected.
It's an ecosystem. And frankly, paying interest sooner might be a strategy. If you have variable income, maybe a commission-based job, paying more interest in a year where you need the deduction might make sense.
Okay. We have laid out the pieces. We have the foundation with permanent rates. We have the work bundle, the overtime and tips, the lifestyle perks, the cars and salt, the family credits, the debt deductions.
All the building blocks.
Now, I want to put it all together. This is section 6, the secret sauce, stacking.
This is where we move from knowledge to wisdom. This is where the guide shines.
Let's paint a picture. Let's take a listener. Let's call him Alex. Let's build a persona for Alex.
Okay, let's say Alex is 32. He's a millennial. He works in healthcare. Maybe he's a radiology tech. So he's an hourly employee, but highly skilled.
Good. So he makes decent money. Let's say his base salary is $85,000. His wife, Sarah, works part-time, makes another $40,000. So household income is $125,000.
Okay, and they've got kids.
They have one toddler.
Go ahead.
Alex works a lot of overtime. He has student loans. And he just bought a new Ford Explorer to get to work safely in the snow.
Perfect profile. On the surface, Alex looks like he is doing well. He might think, I make $125,000. I probably don't qualify for tax breaks.
Right.
I'll just take the standard deduction and move on.
Exactly. He thinks he's priced out of the help. He thinks the tax code is for the super rich or the very poor.
But let's run the stacking simulation. Let's see what happens when he applies the 2026 rules.
Step 1. What's the first thing he does?
Alex contributes to his family HSA. He maxes it out. He sets up an auto transfer. That is $8,750 wiped off his taxable income immediately.
Boom. AGI is lower. Step 2.
Alex has student loans.
Yeah.
He pays his interest faithfully. Because he layered his AGI with the HSA, he is safely under the income cap. He fully qualifies for the $2,500 student loan interest deduction.
So that's another $2,500 off the top.
Off the top.
We're down over $11,000 already. Step 3. The new car.
Alex bought that Ford Explorer. It's U.S. made. He pays, let's say, $3,000 in interest this year because rates were around 6%.
Okay.
That is deductible now. Another $3,000 off his AGI.
Step 4. The big one. The grind.
The overtime. Alex pulled a lot of double shifts during flu season. He has $10,000 in overtime pay. But remember, we only deduct the premium.
Right, just the half part of time and a half.
So let's say the premium portion of that was roughly $3,300. He checks his pay stub. It's coded correctly. He deducts that $3,300.
So let's look at the scoreboard. We have deducted HSA, which was $8,750. Student loan, $2,500. Car interest, $3,000. And overtime premium, $3,300. That is, doing the math in my head, roughly $17,500 reduced from his adjusted gross income.
Correct. So instead of the IRS seeing $125,000, they see roughly $107,500.
And remember, he still gets the standard deduction on top of all of that.
Which is another $29,000 plus for a married couple.
Yeah.
So his taxable income is plummeting.
Because of the credits. By lowering his AGI, he ensures he is nowhere near the phase out for the child tax credit. He gets the full $2,200. He might also qualify for better savers credits or other nuanced benefits that cut off at higher incomes. He's protecting his eligibility.
That is incredible. The synergy of the changes is greater than the sum of the parts.
That is the aha moment. If you look at these rules in isolation, you might say, oh, the car deduction only saves me $600 in tax. But because it lowers your AGI, it might unlock a $2,000 credit you otherwise would have lost. It's a domino effect. One good decision tips over the next one.
It really is. It's building a fortress around your income.
But there is a danger here. We touched on it at the beginning. The withholding trap. Let's go back to Alex.
Yes, this is so important. Alex's employer, the hospital, doesn't know about his car loan. They don't know about his student loans. They might not even know about his HSA if it's an outside account.
So they are taking taxes out of his paycheck based on his gross income of $125,000.
Exactly. They are withholding as if he owes full tax on every dollar. They are over withholding massively.
So Alex is going to get a huge refund in April 2027.
Which feels nice for 5 minutes. It feels like winning the lottery.
It's not.
But financially, it's terrible.
Why is it terrible? Explain that.
Because he gave the government a $6,000 or $7,000 interest-free loan for a year. Inflation ate away at that money. He could have been putting that extra $500 a month into his 401k or paying off high-interest debt.
Or just buying better groceries.
Right. Or investing it. It's the opportunity cost.
So what should Alex do today?
He needs to adjust his withholding. He needs to file a new W-4 with his employer. There is a section for deductions.
Right on the form.
Right there. He can estimate his deductions, the car, the overtime premium, the HSA, and tell the payroll system, hey, don't tax me on this amount.
That puts the cash in his paycheck now, every 2 weeks.
Right. But, and here's the warning, don't go too far. You don't want to owe a massive amount at the end of the year and get hit with penalties. The goal is to break even.
Or, here's a strategy I like. Take the extra money you save each month, say it's $400, and put it in a high-yield savings account.
The self-escrow method. I like that.
Exactly. Then, if you do owe a little bit at tax time, you have the cash sitting there, but you earn the 4% or 5% interest on it all year, not the government.
That is the sophisticated play. That is the options play.
So, looking at the calendar again, it's February 6, 2026. If you are listening to this, you have almost the entire year to set this up.
You can open the HSA today. You can check your overtime coding today. You can refinance the car or check your loan paperwork today.
This isn't about looking back. It's about looking forward. It's about seeing the board.
Precisely.
Let's wrap this up with some key takeaways. If you were taking notes or if you were driving and couldn't take notes, here is the cheat sheet.
Number 1, rates are permanent and the standard deduction is your baseline foundation. It is the floor, not the ceiling. Build on top of it.
Number 2, the blue-collar deductions, overtime and tips, and the big purchase deductions cars are now above the line. This is a historic shift. They are for everyone, not just the rich people who itemize.
Number 3, credits like the child tax credit are powerful dollar-for-dollar savings, but they are income sensitive. You have to protect your eligibility by managing your AGI.
And number 4, the most important one.
Stacking. Stacking is the key to unlocking value. Don't look at one rule in isolation. Look at how they all fit together to lower your AGI and unlock credits.
And as we close out, I want to leave you with a thought. We often treat taxes as something that happens to us, like the weather. Oh, it rained today. Oh, I owe taxes.
But that's a passive mindset. Tax, software, TurboTax, H&R Block, that just reports history. That's looking in the rearview mirror.
Tax planning creates options.
Right. The listener shouldn't be asking, what is my refund? You should be asking, how did I structure my income?
I love that. How did I structure my income? It sounds so much more empowering.
And if you want to play around with this, the source material actually mentions a 2026 tax scenario calculator. It's worth finding a tool like that. Model it. What happens if I work more overtime? What happens if I max the HSA? Run the simulation.
Because options are what financial security is built on.
Couldn't said it better myself.
Thank you for diving deep with us today. Go check your pay stubs, go look at your car loan interest statement, and start building your stack. We will see you on the next one.
Stay curious.
Bye for now.
I hope you found the information in this podcast as interesting as I did in creating it. Now, the best thing we saved for last. We have created for you the 2026 Tax Scenario Calculator for Millennials. Now, this is a great tool. It's very comprehensive. It will allow you to actually sit down when you have the numbers on your income and deductions, those kind of things, and put them all into the calculator, and it'll give you a very good idea of what you're going to be able to take home every paycheck after these deductions are calculated in. And as the article mentioned, you're going to have to work with your employer to make sure that you requested the appropriate deductions in order for you to be able to take home more in your paycheck. Again, this is a great calculator, and it's free, absolutely free for you to be able to use, and it's in our article, which is titled 11 Best 2026 Tax Changes for Millennials. And if you go to that article, you'll find a large icon in there with a picture. Click on that to go over to the calculator and use it. But I would strongly recommend that you read the article before you go to the calculator. It'll give you some information that you're going to probably need to use a calculator. And good luck with it. Thank you for coming to our podcast. Please go to retirecoast.com and read more articles in our Millennial Financial Lab, which includes both our subscription program and some free calculators and free articles as well. Thank you for coming back, and please return to Retire Coast Podcast.